Welcome to the Jill on Money Show. It's Friday, July 5th. I know, very few of you are working. And just because the Labor Department is filled with people who are very nice, I'm not going to be slamming them and say, why on earth are you releasing the monthly jobs report on the day after Independence Day when basically no one's working? But okay, they're going to do that. We don't know what it's going to be. I can't imagine it's going to be particularly market moving the Friday after Independence Day, where it does really seem like nobody's working the entire week. We're working, though. In fact, we are here answering financial questions. And if you've got one, just go to jillonmoney.com, click the Contact Us button, and let us know if you would be willing to come on the air. Now, while you're on the website, don't forget, you've got to check out our service. It's called Jill on Money Live. This is for $35. You have access to quarterly live webinars. We just concluded our webinar last week with Heather Schreiber. It was all Social Security all the time. It was amazing. It was really just the most incredible, quick-paced hour on Social Security you could imagine. So helpful, so interesting, and we're going to have her back. I just thought she was amazing. So if you want to check that out, for $35, you can go watch that webinar from last week. You can also get 4 more live webinars. You can also get bonus video content or anything else we decide to put up behind that paywall. So check it out, Jill on Money Live. Okay, now today, our Friday focus is about tax smart investing. And I always think it's funny when people start talking about their investments as if they I have this, but they don't really factor in that taxes are due. The great thing is that the long-term capital gains rate is lower usually than whatever you're paying in your ordinary income taxes. So that's kind of cool. So we always field questions like this, and we're always happy to kind of clump this together on a theme. And today we're talking about tax smart investing. Here is our first email from Ben, who is 61 and single. And Ben says, I currently have $1 million in a managed IRA account, $1 million in a self-managed IRA account. That's funny. You can kind of decide who's better at it. $200,000 in a managed Roth IRA, $200,000 in a managed brokerage, and then another $250,000 in cash and high-yield money market and CDs. Okay, question. Should I switch from managed to self-managed and invest in index funds to reduce the costs? That's number one. I can add $2,000 a month to my non-managed brokerage account. Should I put it in a stock index or just keep it in a high-yield money market or a CD? And number 3 is I believe I'm okay from a retirement savings perspective. Am I correct? I have the flexibility to retire anytime from age 63 onwards. Ben, you are amazing. I don't know how much money that you actually spend right now, but I'm presuming that because you are adding $2,000 a month to your brokerage account, that's pretty amazing. It does not seem like you need more money in cash right now, so I don't think that's necessary. You probably, depending on, again, how much money you spend, I'm guessing you probably don't spend that much money because you've accumulated a ton of money. It is absolutely fine. You should be just perfect. Now, of course, you'll wait to claim your Social Security until you're 70 if that's possible for you. I mean, I don't think that that's going to be a problem, but fine. In terms of managed versus self-managed, a couple of things that I would like to at least consider. There may be something nice in not having the worry of having it managed as long as it is managed for tax efficiency. And sometimes I note that when you're having your money managed, it is incredibly important for you to make sure that this is happening. Now, a lot of automatic platforms will do this for you, and it may be worth your while to just double check with the person managing your money that that is happening. In terms of whether you should just invest in index funds to reduce the cost, sure, you could do that, but you've got to make sure that you are comfortable doing this. And, it's funny, you sort of have half and half right now. Maybe you've had plenty of time to manage this on your own. You feel confident in yourself. Then obviously owning index funds and not moving things around too much will help you have efficient investing, right? Because you're not going to create a lot of tax liability. But if you just want to save costs, sure, you can go ahead and switch to all self-managed, but it's all on you, Ben. I don't want you got to be careful. To some degree, I just want to know why you have two accounts, self-manage and manage. And if you don't trust yourself with all the money, it's okay to pay for help. It really is. All right. Our next email is from Amy, and the subject is tax loss harvesting. And Amy writes, "Hi there. I'm wondering if you would be willing to tell me about tax loss harvesting. How does it work? What are the pros and cons? My husband and I are in our early 50s. We don't have any kids, no debt, homeowners, and feel like we're in very good shape for retirement in terms of savings." She goes on to write, "We have about $600,000 in a brokerage account at Vanguard. It's invested primarily in index funds. An advisor at TIAA recently suggested that we should consider tax loss harvesting for this brokerage account to minimize capital gains and taxes. What do you think? How does this work? Are there disadvantages to doing this? Thanks." Okay, I love this question, Mark. Man, this is a great, great question, because I think that many people really do confuse tax loss harvesting with rebalancing. And they can take place at the same time. But essentially, what you're trying to do is you've got to look at your taxable brokerage account, and you're trying to see where there are losses in this account. So if you have a loss, so let's kind of like play this out. It's very hard to imagine this because markets have sort of feels like they've gone straight up for the last year and a half. But let's go back to 2022 and explain how this might work. In the year 2022, we know that stocks went down. And for a lot of people, some of the positions in their accounts, in their taxable accounts, showed losses. So the reason why we say tax loss harvesting is that what we say, let's sell any loser in your account right now. And we can also sell that against a winner. So if you've got a loss of $10,000 in one position, a gain of $10,000 in another position, and you sell those out both, you have net neutral taxes, but you have an extra $20,000 to reallocate. So if you have more losses than you have gains, then what you're allowed to do is carry forward your losses in the future. So maybe you say, this year, I'll take all the losses this year, and I don't even have to take the gains. I just want to take the losses and reinvest. But I'll have the loss available to me in the future if I want to take a gain against that. If you have more losses than gains, you can also take up to $3,000 against your ordinary income. So it's kind of great. The reason why so many people love this strategy, and we do sort of conflate tax loss harvesting with rebalancing, is that when you do this, usually most people would do this tax loss harvesting at the end of the year, like once a year at the end of the year. You can use your tax losses or those positions or the dollars you freed up from doing this to actually put your portfolio back in the balance that is really according to your own allocation. So I think it's a great idea. I think in a taxable brokerage account, tax loss harvesting can be really smart once a year. And I think that's it. So I would check that out. And I'll tell you what, Amy, if you have a question and you want to follow up with us and we want to talk about what's going on inside that brokerage account, maybe you follow up and come on the air with us, because I'd love to take a look at that. And I hope that helps for everyone who's interested in tax loss harvesting, again, for taxable accounts. Okay, let's keep moving ahead. Again, we are talking about tax smart investing. And this note is from Lee. Lee writes, "I need clarification on rules for withdrawal from a Roth. I am single and my 24-year-old son is launched. I supported him alone his first 18 years, and now it's time for me." It's me time, Lee. "My income plan hinges on using Roth dollars from age 63 to 65 before Medicare, and then again from 65 to 70 as non-taxable income so I can do further conversions." Okay, so let's get this down. Lee's going to be 60 this fall, would like to retire in the following year. Lee rents a nice apartment, $2,000 a month all in. I'm priced out of the market unless a 55 plus condo complex comes up. They run, well, who cares? We should not doing that right now. Okay. I have $150,000 in a fund to buy a home in treasuries and high yield savings. If I don't buy before I retire, then I will throw the money into the market as a long-term care healthcare fund. All right. So just remember that, gang. 150 grand set aside for a potential purchase in a condo complex. This seems like a bad idea, just to be clear. I know your rent goes up every year. It's not going up 10% every year forever. It just went up 10% a year for the last few years. But, $300,000 for a condo, $2,400 of taxes, plus a HOA, a homeowners association fee of $275 a month, which, by the way, will also go up like 10% a year. I don't think that's going to happen, but okay. We got 150 grand set aside. Right now, there's some money in a 401k, 16 grand in a Roth 401k, 67,000 in a traditional 401k. In an investment company Roth IRA, I have $185,000. The first contribution was in 2009. So she put $92,000 in, and then there was a conversion for $45,000 and then earnings. Then there is a traditional IRA, which has $770,000. There's another. So now we have another Roth IRA, a brokerage account of 15 grand. That's separate from the 150. Okay. So now there are 401k contributions that are planned and, for the next couple of years. And then at age 65 to 69, take out 50 grand a year and stay what is under the IRMAA earnings bracket, meaning Lee's going to take out enough money that she stays under this threshold that would incur some extra costs for Medicare. Okay. If my required minimum distributions are too high in the future or I don't need the funds, I will just do qualified charitable distributions, 55 grand in emergency funds, and then a bunch of stuff. Okay. She's got pensions also. Pension of $565 a month goes down to $500 at age 70. Then another pension with no COLA. That's a lot of money, and Social Security and all this stuff. Okay. So let me just start by saying this. Lee is in amazing shape. This is a little bit of extra work that I don't think you need to make yourself crazy about, but you seem to want to. So I'm going to go just dive in. I am not clear why you are pulling money out of the Roth accounts. I don't quite get it. I see that you would like to minimize future taxes, but I really don't get why you are so apoplectic about IRMAA. I don't get it at all. And in fact, I don't even see why. I'm not sure why you're necessarily putting money and moving stuff and converting stuff. I don't think you really need to do that. I just want to say one more time. Ed Slott pointed this out to us. It is so true. People are insane about IRMAA. If you are single and you earn less than $103,000 this year, you have no surcharge. If you make between $103,000 and $129,000, do you know how much that IRMAA is that you're so desperate to avoid? It's like $1,000 for the year. Okay. And we're talking about hundreds of thousands of dollars. Why are we doing this to ourselves? Lee, I'd love to see. This is when I really want you on the air because I want to know why you're so nutty about this. You've got so much money that you've saved and you have done a good job raising the kid. So why not just pull this money out slowly but surely, stay in a decent tax bracket? You're going to stay under the 22% bracket probably, or maybe 24%. But really? This is nuts. This is absolutely nuts. You don't need to do this. Okay. This is from Ray. Here comes IRMAA. Here we go. Ray writes, I'm planning to sell a rental condo in California next year after the taxes. So the rentals, when you have a rental, gang, you sell it. It's not just a capital gain that you have to pay. You have to recapture the depreciation that you have claimed over the years for that rental property. Okay, so let me go on to Ray. So after the taxes and the recapture and capital gains and California ordinary income, the question is, the real kicker will be the IRMAA Medicare bump for me and my wife. Can you find out, since the condo is in my name? Oh my God. Okay. I'm sorry. This is great. I bet that this is like a real rental, like a real number that he didn't say how much the condo is sold for. But basically, should they be married filing separately since his income will exceed his wife? Thanks, Ray. Ray, take a deep breath. Pay the IRMAA for 1 year, and then you don't have to pay it ever again. 1 year. That's all we're talking about. Gang, come on. It's something about this IRMAA that really freaks people out. IRMAA is about modified adjusted gross income, right? Just to be clear, I'm just going to read what this says. For IRMAA, modified adjusted gross income is defined as AGI plus tax-exempt interest and untaxed foreign income. Medicare uses the MAGI, the MAGI, reported on the federal tax return from 2 years ago. For example, to determine whether someone will pay higher premiums for 2024, Medicare uses 2022. So just so you're clear, the tax return that you're going to file this year will be used to calculate IRMAA for the year 2026. Okay? So listen, I don't know why you're making yourselves so crazy about this. What I'm hopeful is that like you made a ton of money on this condo. Do I really think it's going to be worth filing separately? Probably not. And I presume that there's some way that the government will find out about it, but maybe they won't, but you're going to have to still file separately. And that's a pain in the neck in and of itself. Anyway, I would talk to a tax preparer to see if that's something that you can do. I would never in a million years take on this project of avoiding your IRMAA. It just doesn't make sense. Mark, you have anything else to say about IRMAA?
With the same thing I always say, it's a good problem to have. Would you prefer the alternative?
Yes. It's like you made some money. It's okay. Okay. Everything's going to be just fine. All right. That is it. That is the program. This program is just a delight every single time. And, if you're really worried about IRMAA, we would love to talk to you off the ledge. Okay. And if that's something that you need, give us a holler. Go to JillOnMoney.com, click the contact us button. Let us know if you would like to come on the air with us live. Mark will arrange for that. Check out all the content that lives on our website at JillOnMoney.com. You can see it there. You can subscribe to Jill on Money Live, $35 for the whole year. And of course, you can sign up for the free weekly newsletter. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. Don't forget to leave us a rating and review wherever you listen. All right, it's Friday, so we do some business. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web. He's also the executive chef here in this family here. We're one big family. We are distributed by Odyssey. Please do something nice for someone else today. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you tomorrow.